OpenAI. They just pulled off one of the most complex, I would say, corporate restructurings.
And I think his concern was that anyone who controls this can have too much power.
Set up these family office LLCs. If they do it right, you got to dot your I's and cross your T's, but it flips the expenses that are affiliated with managing your wealth and growing your wealth from non-deductible to deductible.
Usually these entrepreneurs had a business and a big business exit. And if that's the case, they're used to writing everything off through their business. Now their business is gone, and they're saying, well, I have no write-offs.
Right. The public equity still represents about a third of the billionaire's allocation.
Billionaires have a system and a process and a team that vets things, and often entrepreneurs are just talking to their buddy and throwing money in there.
Okay, hey, Dew Wealth creates these fractional family offices, but at what stage should I create my own family office, and how much do these things cost to build? All right, Jim, welcome back.
Thank you.
I'm
Good
excited.
to be here.
We got a heavy docket today. I know we're just talking about it.
Yeah, there's a lot.
So today we're going to go through how entrepreneurs can leverage some entity structures modeled after OpenAI's transformation of going from nonprofit to for-profit. And then we're going to also talk through how entrepreneurs can build their own family office LLC, maximize some tax deductions. And then we're going to wrap up with, we're just 2025. We got to talk about AI.
Of course. I would expect nothing less.
Yep. And what skills are necessary according to the World Economic Forum over the next 5 years. I thought it was very interesting. So we've got a good docket here. And I think let's start with OpenAI. They just pulled off one of the most complex, I would say, corporate restructurings, going from nonprofit to, some would say, worth maybe close to $1 trillion for-profit machine. And there's a playbook here. And so just to set the stage, OpenAI originally started as a nonprofit in 2015. They wanted to have open source AI, hence OpenAI, ensure AI benefited humanity and have it be owned by a nonprofit. And now they just recently did a capped profit hybrid structure, and they're going to do a full conversion to a Delaware Public Benefit Corporation here in the next year. So I know you track OpenAI closely, you track AI closely, and then we'll do the first chart up here of who owns OpenAI. So we got a chart here that shows who owns AI. This shows the current cap table of OpenAI. What are your thoughts, Jim, on this and the restructuring that these guys are doing?
Yeah, well, it's interesting because Elon, his whole idea with this and why he called it OpenAI is to make it available to everybody. And I think his concern was that anyone who controls this can have too much power. So if you think about that, it's going against what Elon had hoped for, right? And I think we were talking about earlier, you said that he's calling it closed AI now because they're becoming a for-profit. It makes sense because if they're raising money doing things like that, no one wants to give money to a nonprofit. They want to give money to a for-profit business so that they can get a return on their capital. I mean, those are my thoughts off the top of my head. What do you think? You're much more into this space than I am.
Yeah, I think the other thing I think that was important for OpenAI here is they needed to figure out a way that they could have their existing employees and other shareholders monetize the investments. And so with this new structure, Microsoft's going to own maybe around a quarter, just over a quarter. And so although this is an interesting play for entrepreneurs who may want to get exposure to OpenAI, it's privately held, but Microsoft does have a large cut of the cap table there. And then there is still a nonprofit arm, and we'll talk through how you can go from a nonprofit to a for-profit. You can't essentially, there still has to be some benefit for the public good. You have to do evaluation, et cetera. But I think the big thing is just they're able to increase the amount of equity compensation they can give to their key employees, and they can continue to raise more and more capital. And with the whole data center build out, the AI build out, they just need a bunch of capital. And so I think they needed the flexibility on their cap table.
Yeah, it's interesting. And just as a side note, your comment about owning Microsoft to own OpenAI because they're such a big holder of that position, it's the same argument when you say, well, I don't have any international in my portfolio. Well, maybe you own U.S. companies that have significant international exposure, so that can be a way to get international, although you do lose the currency play if the U.S. dollar gets weaker by having some international. That can help you on that side of things. But same thing with Microsoft, owning Microsoft or even owning a big company that has a large ownership stake in a company that's private is a way to get exposure. So I know that's not exactly what we're talking about, but I thought that'd be worth mentioning.
Yeah, no, definitely interesting. And then mechanically, when you're going from a nonprofit to a for-profit, you have to do a fair market value assessment to value the underlying assets, or at least the private, or I should say the nonprofit part of the balance sheet there and the fair market value, because then that needs to still be a nonprofit. So they do a valuation, they determine essentially what is the value of this cut, because again, part of the ownership is still going to be owned by the nonprofit arm. And so then that's how they make sure that otherwise everyone would start as a nonprofit and then flip to a for-profit, because it'd be a tax loophole. So as part of this, that's an important piece of this. And the valuation, I'm sure, will be scrutinized by the IRS, because that's going to be a big determinant. And essentially the fair market value that they come up with and they derive, that is what essentially has to go to their nonprofit arm over time in terms of equity, cash payments, et cetera. So that's, I think, an important thing of if you're an entrepreneur and saying like, well, why don't I just start a nonprofit and flip to for-profit? You can, but all of the equity or the enterprise value build up until that trigger date needs to essentially still be locked in for the charity. And then any growth essentially above that, you could tuck in underneath a for-profit arm.
Yeah, makes sense. And as you said, I've known entrepreneurs that want to start their own nonprofit, and there are certain advantages to that, but it's really because they want to make a difference in a specific part of the world or in a specific group of people they're trying to help. And so they do a nonprofit. But yeah, going from nonprofit to profit, this is the biggest I've ever seen in that space, and it's usually fraught with a lot of challenges.
Yep. All right. Well, we got the next chart here, and this has heavily been talked about not only in the tech space, but also in the finance space, is the capital flows among not just AI, but all of the different players and really that are building out the AI. And we got a chart here that shows OpenAI, Microsoft, NVIDIA, CoreWeave, AMD, and Oracle. And really just what this does is just shows all the money in terms of chip purchases, infrastructure, equity investments, and revenue sharing between all of these different businesses. And the fear are all of these companies just so intertwined that they're like making themselves too big to fail as an ecosystem. And NVIDIA really is the big dog in the game here with the hardware and the chip the chip manufacturer. And so there's huge contracts with OpenAI and CoreWeave wanting to buy as many of these NVIDIA chips as possible, but they may not have the capital. So they may be just, doing certain type of equity swaps and different types of different relationships here. And so when you look at something like this, Jim, right, these are all publicly traded companies except for OpenAI that you're looking at here. Does this make you concerned how interrelated these all are now?
It does. I think the mitigating factor is where AI is going. And this is not something that's going to plateau, but this whole circular movement of money is concerning, because if you had a problem, then it hits across all these different areas with all these huge companies. And the other thing is, if you think about things like profits and PE ratios and those kinds of things, you go, is it real if you're paying me and I'm paying you, and that way we're driving up our revenue and our earnings? Does that really mean that there are real earnings here if we're just paying each other? And I think the answer is yes. And I also believe that we're still in its early stages. It's going to be so big and powerful. But, this kind of comes back to some of the questions in the stock market, because the stock market is valued where it is because it's betting on AI in the future. And the question is, will that AI bet come through as the market is reflecting today in prices? I don't know. Anyone's guess, I guess, for sure. I would say AI is in the early stages, and we're going to see it having a huge impact everywhere, not just with these companies.
Yeah, I mean, we're seeing a big impact in our business already, which has been awesome to see. And hopefully every entrepreneur is forcing their team to incorporate AI into their workflows. And actually at the end of this session, we're gonna jump into some examples of exactly what we're doing there. So that's it on the OpenAI transformation. So it shows what's possible when from a nonprofit to a for-profit structure. Let's talk about another structuring topic, but really for 8 and 9 figure entrepreneurs who have that liquidity event, or really who want to create their own family office and family office structure. We're going to talk through the tax benefits and tax court cases that legitimatize a family office LLC, as I'll call it. But before we jump into that, Jim, I think it'd be useful for you just to maybe tee up, what is a family office and why would an entrepreneur, even if an 8-figure or 9-figure entrepreneur, not a billionaire, want to create or mirror a similar structure to the Billionaire family office?
Yeah, and the Billionaire family office, which was started by John D. Rockefeller in 1882 when he was worth about $18 million, which was a lot of money in 1882. And he had this same problem that entrepreneurs have, which is over your lifetime as an entrepreneur, you pick up an attorney, an accountant, an insurance agent, a banker, an investment advisor. And if you get all these professionals and you picture those like spokes on a wheel, they're usually not all A players. They're not talking to each other. There's no collaboration. No one's holding them accountable. And the worst part is the entrepreneur is in the middle of that wheel trying to manage that team when they don't have the time and the expertise to do that. And that's what John D. Rockefeller found himself in the middle of that, what we would call a financial flat tire. So what he did is he said, I tell you what, I'm just going to hire all these professionals that I need as full-time employees just working for me and my family. I'll put them in one office building, and I'll call that my family office. So that's where we believe the term was coined 140 years ago, and every billionaire has followed suit, because when they're employees, you can manage them, control them, hold them accountable, and also have a collaborative and coordinated effort. And so, of course, what we do is we help that way with a fractional family office. But to your question, when he made that transition, then you're running a little bit like a little company that's running your wealth. And we see that with entrepreneurs that, often are post-exit, or they've established maybe a 9-figure balance sheet. Maybe they're making millions of dollars in income every year, and they need more support. And so how can you do that in a way where you can actually create some tax deductions? Because often they just pay a bunch of people, and that's fine, but there's a way you can do this in a more tax efficient manner. And that's something I think that you're going to cover here today.
Yeah, exactly. And so just to provide the tax framework here, there's section 212 of the tax code. And this was essentially your miscellaneous itemized deductions. And in the old world, which was pre-2017 Tax Cuts and Jobs Act, which was President Trump's last tax bill, you were able to write off your investment management expenses, investment research, portfolio management expenses, if in aggregation all of these things were over 2% of your adjusted gross income. Well, that disappeared with the 2017 Tax Cuts and Jobs Act. So now, if you're just working with a Morgan Stanley or a Merrill Lynch or any typical advisor charging you 1%, you're not writing any of that off. And so where you want to do is get to section 162, because section 162 of the Internal Revenue Code is what defines trade or business. Now, deductions are available for ordinary and necessary. That's what's always said. Is that an ordinary and necessary business expense paid or incurred during that tax year? And so what you want to do when you're creating this Family Office LLC or entity, or like you said, this kind of small business, is you want to make sure you're hitting the requirements of section 162 trade or business. So said another way, you want your Family Office LLC to provide services in exchange for revenue, not just managing your own money. And there's a really good tax court case. This was Lender Management LLC versus Commissioner. So this was a 2017. And this really set the playbook for all family offices to legitimize the ability to say, hey, managing my wealth, if I'm setting this up appropriately as a Section 162 trade or business, can drive legitimate deductible expenses. And so what this tax court case was a family office that managed assets for multiple family branches. They hired staff, maintained their office, produced reports, and they had, importantly, formal management agreements with performance-based fees. So just like any other professional who was managing assets, they were charging a management fee, they had carried interest, right? They were monetizing the investments of the family office. And so when the tax court case looked at this, they looked at the fee structures that resembled commercial investment firms. So, 0.5% to 1% AUM, they had performance fees, they had formal documentation, so written investment management agreements, they had a dedicated staff, compliance procedures, investment committees, and then they also provided other, and services outside of just investment oversight. So cash flow management, tax planning, estate planning, all of that kind of stuff.
And by the way, all that stuff sounds like a lot, but this is stuff that would be smart to do anyway. I mean, you really want to have your stuff dialed in. If you have a large balance sheet, you want to have the way it's being managed and the people who are helping you want that dialed in, which is what these things would do in addition to set you up for deductions.
Yep, exactly. And then this contrasts with the Higgins versus Commissioner. This was a 1941 tax court case where the taxpayer tried to write off investment management fees. But in this situation, the tax court case deemed that these management fees were simply reimbursements. There was not an actual service agreement, and this was not a Section 162 trade or business. So,
and just by the way, in 1941, I was very young.
Very humble. I appreciate it. So where we're at so far is that there is a framework using the Lender Management LLC versus Commissioner tax court case. There is a framework whereby 7, 8, really mostly 8, 9-figure entrepreneurs, and we work with some, we're going to go into a case study here in a bit, can set up these family office LLCs if they do it right? You got to dot your I's and cross your T's, but it flips the expenses that are affiliated with managing your wealth and growing your wealth from non-deductible to deductible. And then that's really the angle here is the tax angle. But on top of this, as we're going to talk about, it actually really also helps from a intergenerational wealth transfer perspective, because now it's easier to incorporate your family within this family office LLC and the governance that's created as part of this entire legal operation build out.
Yeah, very smart.
All right, so let's talk through how you actually do this. So there's a we're going to go step by step. So the first step you're going to want to do is create, let's say, an LLC. All right. Now, most of the time you're going to want to create this LLC in a state such as Wyoming or South Dakota, because if you're a 8 or 9 figure balance sheet entrepreneur, you care about your privacy. So Wyoming and South Dakota, important there. Second thing you're going to want to do is, again, Section 162, ordinary and necessary. So we got to actually create revenue streams for this family office LLC. So this is where you're going to want to be providing, whether it's management services to the different portfolio companies, or managing maybe properties, real estate properties, managing investments. And so you're going to want to structure this with management fees. You're going to want consulting services, board advisory fees, carried interest, right? The family office LLC needs to actually monetize and charge fees for the management and execution of all of the different assets that you as the family would be needing help getting managed. And all of this needs to be put into legal agreements, investment management agreements. So it's not just about theoretically moving the money around, but arm's length agreements executed and drafted by attorneys.
Yeah. And then the tax benefits, as well as the other benefits we talked about, are really helpful here.
Yep, exactly. And so now when you are building out different accounting systems, you've got the QuickBooks, QBO Online or whatever, you got full stack P&Ls, you got balance sheets. I mean, you're running this just like a business, right? You got revenue, you've got expenses, whether that's full-time staff, whether that's fractional staff. You're going to have a bookkeeper, maybe you have a fractional CFO or family office team, analysts, whatever it may be, office space, technology, whether you're on Bloomberg or Adapar, Orion, whatever it may be. So that is all going to be deductible here. So last thing let's talk about here, Jim, is the SEC registration decision, because we are registered as an RIA underneath with the SEC.
Yep.
And under 17 CFR 275.202A, that essentially has a carve out where family offices can register with the SEC so long as they are serving only family clients and they're wholly owned and controlled by family clients, and they do not hold out as an investment advisor to the public. So if they do that, they can be registered with the SEC, but they're an exempt entity. It's a family office exemption. So why would someone want to do this? The downside of registering with the SEC as a family office is you're now public, because all of this is publicly available information, right? Just like all of our information is publicly available as a registered SEC RIA. So that's the downside. But the positive of doing this is now it further could legitimize your case that this is a true family office, collecting fees, managing the family's wealth. It just adds more iron to the fire at the trade-off of privacy.
Yeah, and I think that's a case-by-case decision. I usually would say, if all things are being equal, don't register.
Yeah.
If you have that option, but there are, as you said, real benefits. As we talk about ordinary and necessary, I was wondering, are my jokes ordinary and necessary within the company?
No.
They're definitely not ordinary.
Definitely not ordinary.
I think they're kind of necessary. I think you have to keep people light.
Yep.
And since they're very funny, I think they are necessary.
There you go. If
Definitely
that's
not
going to make
ordinary.
you sleep better. But yes, your dad jokes are not ordinary. You would think that with the advancement of AI, your jokes will get better because you could leverage AI to have better dad jokes.
It's true.
But your jokes have actually maybe plateaued, some would argue.
I would say that because I don't go to AI, mine are original. If I go to AI, you'll have people copying my stuff.
That's how you know you're an old dog, is that you are not using AI for your dad jokes. All right, well, let's go to the next chart before we jump into an example here. So I've got another visual that we're going to throw up on the screen here. And I think a lot of entrepreneurs ask, like, well, at what stage should I create my own family office? Okay, hey, Dew Wealth creates these fractional family offices, but at what stage should I create my own family office, and how much do these things cost to build? And so this chart here that I'm going to show, I'm going to start at the low end. So a low end, and this is based off of Campton Wealth and RBC data here from 2025, a small family office is going to have 100 to 250 million. And so that really is the floor of when you're going to really even want to start thinking about maybe doing this, is 100 to 250 of kind of liquid net worth. And here it says that the average cost, annual cost for a family office, again, a small family office in this space, is $1.1 million, or as a percentage of the net worth, 62 basis points, or 0.62% a year. So again, if I was worth $200 million times 0.62, in that case, it'd be 1.2 million. So that's kind of the low end. Now, if we go to the high end, the very large family offices, these are those managing over $1 billion of net worth. So think of all of the billionaires we think about all the time. The average cost here is $9.8 million per year, right? So that's the cost, the burn rate essentially of this family office team, $9.8 million. They average 20 employees. But then the average fee is 35 basis points, or 0.35%. Now, of course, as you're getting a bigger and bigger number, right, in terms of your assets, you multiply that by a smaller and smaller percentage, and that's why that basis points will be lower and lower as you get larger and larger.
And you get efficiencies of scale, but still a $50 billion entrepreneur is going to pay more for his family office or her family office than $1 billion entrepreneur. But it won't be 5 times it. It'll be less because of the efficiencies.
Yep. And so I think that as a rule of thumb, if you're an entrepreneur thinking of building your own family office and not going with a fractional family office or not doing it on your own, you're starting at 7 figures a year in terms of your annual cost. That's your annual burden rate. So you got to make sure you're getting at least $1 million of incremental value out of setting up your own family office. And here again, in that small size, which again is kind of, we see entrepreneurs that are buttoning up to this small size here. The average small family office has 3 employees, again, costs are just over $1 million a year, which makes sense. These are very high paid professionals that you're going to have on the team, and it's only 3 full-time employees, and then the rest would be outsourced.
Yeah. And you're still doing quite a bit of outsourcing at that level. The bigger they get, the more once you're in the billionaire status, they try to keep more and more in-house.
Sure. All right. Well, let's do a transition to our next segment here, behind closed doors. Let's put a case study together on this. So we've got a case study. This is loosely based off of some entrepreneurs we've got who have set up very similar structures here. But let's assume that we got an entrepreneur that's making $20 million a year in annual taxable income, so not revenue, but take home, operating real estate businesses. They got GP stakes, just a lot of different things going on within the real estate sphere. 9-figure balance sheet already. They're managing 4 to 6 active development projects, tracking 30 plus passive K1s and passive deals. And then on top of that, they're also paying $400,000 per year in non-deductible expenses, right? Attorneys, advisors, right? All these different professionals just to help kind of manage and keep all of this stuff clean. So that's the setup here. And so the idea is, hey, okay, should this entrepreneur create their own family office LLC, whereby this family office LLC would be able to provide services in terms of delivering services to operating the real estate companies, passive investment, holding entities, individual development, project LLCs, personal accounts, right? The family office LLC could provide services to all of those different things that are going on in this entrepreneur's life. And then the revenue model, which again is important to make this.
And what do you mean by personal accounts? Can you elaborate on that a little?
Yeah. So within the family office LLC, this would be, for example, if you have stock account, bond account, crypto account, right? Anything to that effect, the family office LLC would be able to manage those investments.
Portfolio management, traditional investments,
exactly.
Stuff like that.
Performance reporting, cash flow reporting. There's going to also be asset protection, insurance, all of that kind of stuff that would be baked into this.
Got it.
So you got to put together a legitimate revenue model. So here, hypothetically, let's assume we've got an $80 million passive portfolio. They charge 25 basis points on that. So 0.25% times 80 million, that's $200,000 a year of revenue. They could also charge an operating business retainer model of maybe $150,000 a year for financial oversight and financial planning. And then maybe there's consulting fees for each active development. So there's clear line of sight here to $450,000, $500,000 a year of, again, arm's length revenue that the family office LLC would charge to these different entities and to these different projects that the entrepreneur is setting up.
Got it. Yeah.
You with me so far?
Yeah, makes sense.
Okay, so what are the services provided? So let's say we get some consolidated reporting. That'd be one big thing. LPGP tracking for all of these different K1s and the passive deals, capital calls, distributions, performance reporting, cash flow forecasting, liquidity management, due diligence. That's very important. Deep diving and also on-site, off-site due diligence.
And by the way, if you're listening, these are all areas that you should be thinking about tightening up and having under control, whether you're doing a family office LLC or not. Things like when you said consolidating reporting across 35 plus entities. Well, a lot of entrepreneurs have 5 entities or 10 entities, and they have no idea about the compliance with them, the operating agreements, how the money flows between them, how it flows into the tax returns, let alone things like cash flow forecasting and liquidity management. So everything that Bryce, you're talking about, our listeners should also be paying attention to within their business.
Yeah. I mean, and these are things that they should be doing right now. The difference is they're not able to potentially deduct these expenses, whereas by tucking them in underneath this family office LLC, using that lender management tax court case as a guide, they now become deductible.
Yeah. And what's interesting is usually these entrepreneurs had a business and a big business exit. And if that's the case, they're used to writing everything off through their business. Now their business is gone.
Yep.
And they're saying, well, I have no write-offs.
Right.
And this is a great way to get legitimate write-offs through actually doing something that's going to help them manage their wealth in a much better way.
Yep, exactly. So here, deductible expenses, right? Let's assume that you're going to pay a fractional family office or bookkeeper, or you have a full-time employee. You got different professional services, tax prep, legal, compliance. You got tech, you got travel. Now we're going to talk about that. Aircraft, as part of that, we're going to jump into this. In this case study, the entrepreneur also owns a private plane, and we're going to talk through how you can actually legitimatize the deductions on some of that. Vehicles, other. So here we totaled up maybe about $490,000 of expenditures. So if the revenue here was, $450,000, we now have $490,000 of expenditures. That would show up as a $40,000 loss, right? And we could actually take that loss. And remember, even in that revenue, we're pulling it out of affiliated entities, again, at arm's length. So we're effectively reducing the taxable income in these other entities by pulling money out and starting a new P&L in the Family Office LLC. But again, as you can see with this case study, with this example, everything legitimate, documented, agreements put in place. So let's talk through this aircraft, because I think there's separate, and this is again part of a real case study, is there's a separate aviation LLC that owns a private plane. And so then what happens is the Family Office LLC will pay an hourly rate to the aviation LLC whenever that plane is being chartered for legitimate business purposes. So for example, if the entrepreneur or if the team is going to vet different properties or is doing underwriting, right? And if that use of that business jet was ordinary and necessary, again, using the 162 language, then you can legitimately deduct part of that airplane expense too, the private jet. So in this case, there were 18 business flights out of 52 total. So 35% of the jet's total usage was for business purposes. So then therefore it could be allocated a pro rata amount of the expenses, and then that can be written off as a tax deduction through the Family Office LLC.
Yeah. As an aside, if you own an airplane, you should have your airplane in its own LLC for liability reasons and everything else. And I don't know that we need to get into it, but you don't want to put your plane into an S corp typically.
Don't want to do that. Yeah.
That creates a lot of problems.
Yep. No debt basis there. All right. So all in, again, now $490,000 of legitimate expenses at a 41% marginal rate. That's going to save you about $163,000 per year in taxes, right? Just being tax efficient with getting something like this set up. So that's the tax angle. Lender management is the tax court case that guides this. Again, we do this quite often with 8 to 9 figure entrepreneurs who don't have the resources to start their own family office, but they want the tax benefits. And like you said, they may usually their post liquidity event, they sell their business. They want to create this Family Office LLC. They want to get some teammates underneath there, run some expenses like us through that. And that way it's a tax deductible expense.
Yeah, very smart. And I don't know about you, but I can always find something to do with an extra $160,000.
Yeah, I'm sure you could. I'm sure it ends up on your left wrist is where that ends up.
Occasionally. It is funny though, and we were talking about this the other day, is the tax planning like this, the key is wealth building. And so especially entrepreneurs, because usually entrepreneurs who have a 9-figure balance sheet are maybe a little bit better at wealth building. They've made it there. But just keeping in mind that whenever you're doing anything to save taxes, for example, there should be a component that's building wealth, not just buying cool stuff or buying stuff for my wrist, but actually wealth building for the future of you and your family.
Yeah, I 100% agree. That's the why. So to wrap this up, there are reasons beyond just the legitimatizing of the expenses to write it off for tax purposes that you would want to consider this Family Office LLC. And 2 big ones. One is going to be governance. And so in these LLCs, when we set these up, we generally, within the operating agreement, want to incorporate succession planning into the governance. And so we can structure different, really what we want to do is structure different investment committees. We want to maybe even do distribution committees of like, hey, what do distributions look like from these LLCs? How does this feed into generally dynastic trusts setup? This is usually all intertwined. And so it allows kids to become, or heirs, become more involved. And then also there's generally a charitable or philanthropic overlay. And so maybe it's not directly through this entity, but the family office will generally then be able to provide some sort of management or other services, perhaps to dynastic trusts that may own a lot of the actual assets that the entrepreneur has, created over time or built up over time. So yes, there's a tax angle, but there's also this can be a dual sword here and also used for governance and succession planning.
Yeah, and I love the thought about multi-generational education and accountability and apprenticeships where young people can learn. I know just recently the rumor is that Warren Buffett changed his estate plan, and he was originally going to give a very small amount to each of his kids. And he decided he's now going to pass 99.5% onto a foundation that the kids are going to, his 3 adult children are going to manage, and they're going to share 0.5%. So what that means is 250 million per kid is a 0.5%, because he feels like they're now mature enough to handle 250 million, but that's 0.5% of his estate. And then they're going to work together to manage 150 billion for charity and for philanthropy. So he's doing that within his plan, just at a larger level than most anybody in the world.
Yeah, and I wonder, going back to Buffett, I wonder what his actual distribution strategy was when they were younger, because now his kids are between the age of 60 and 70 years old, right? Because Buffett's so old.
I think his oldest is 74 or something like that.
Right. So at this stage of their life, I mean, the money doesn't mean as much. And it kind of takes me back to the book Die With Zero, which I love that book. I don't agree with everything in the book, but I think a lot of entrepreneurs and a lot of people should read that book.
Yeah.
Because it's kind of counter to what a lot of people think or feel in the normal world, which is just put your head down, work, save, and then spend it, whereas tomorrow's not always guaranteed.
Yeah, well, I think this would be a good example. The mother of those children, when she died in 2004, I believe, she was worth $3 billion, and she gave each child $10 million. So she actually gave less of her estate, more of her estate. She gave 1% away. And Warren's supposedly going to give 0.5% away, but for her that was $10 million per kid, and for Warren that's now $250 million per kid. I tell you what, though, extremely generous to give away 99.5% of everything you have when you die. Of course, not to one-up Warren, but Mimi and I are giving 100% away of our stuff when we die. We don't have kids, so we just feel like we're a little more generous than Warren Buffett.
But who takes care of Abby, your dog?
Oh, you're right. We better do a carve out.
Better do a carve out.
Okay, so there might be a 0.5%
there you
that
go.
would go.
Abby's going to be eating steak every night.
That's true.
What a lucky labradoodle.
You always have to pour cold water on my moment when I thought I outdid Warren Buffett.
Well, I just want you to live in reality, not in La La Land.
Okay, I'm back to reality.
All right. Well, that's the Family Office LLC. So tangent with the tangent done there. So the Family Office LLC is right. They're managing all these different investment properties, all the different portfolio companies here. Let's segue now into private market. And so I was looking and going through some data from PitchBook. PitchBook did a deep dive on the performance within private asset classes. So this is going to be private equity, it's going to be venture capital, private credit, which is kind of just debt or lending, and real assets. And so next chart that we're going to put on the screen here is the private capital horizon IRRs, or internal rate of returns. And really what this just shows is what were the returns from the start of the year through Q2. So the data is a little bit older over the last 1 year, last 3 years, 5 years, and 10 years. Now, this is annualized figures, not cumulative. So looking at the top chart there, private equity down 1% according to this data source. But if you look over the last 10 years, it's annualized at about 15% per year. And then if you look down, you got real estate annualizing about 7.6% over the last 10 years. But you can see over the last 3 years, with the interest rates higher, right? We know that COVID squeezed a lot of juice out of there. That's been an annualized negative 1.5% over the last 3 years. So as you're looking at these,
multifamily, it would look worse than that, right?
Multifamily. And we're going to talk, also I'm starting to see some cracks in the armor of office spaces too. So as you're looking at this data and you look at the private capital at the bottom there, just as an aggregate basket of just alternative asset classes, what are your thoughts? What are your takeaways?
Well, I believe private capital has to be a part of most entrepreneurs' balance sheet once they get to a certain level of wealth. And it's not surprising. Private equity has led for a lot of the time over the last 30 years, so I'm not surprised about that. And I'm not surprised about real estate. It's been a struggle with the interest rates and the other things that have gone on there. Private capital, important part. I still believe that public equities and public investments also have a part, and the billionaires allocate accordingly. Sometimes I see entrepreneurs that everything is private and crypto, and that's pretty much all they do. And there's value to the public markets. There's liquidity, there is stability. And if we look at stock market performance, it would be on this chart. It wouldn't be the lowest on this chart over the last 10 years, 5 years, 3 years. So that's an important thing to include there too. Any thoughts that you have when you look at this?
Yeah, I think the big thing here is if someone looks at this just from a performance perspective, to your point, I've got the data here that let me find this. So S&P 500 total return is up 205% since December 2019. So that includes the pullback in COVID. The private equity index is up 185%. So the S&P 500 has actually outpaced a basket aggregate of private capital. But like you mentioned, you're getting more diversification when this. Some things are going to zig when other things are going to zag. And more diversification. Like they say, diversification is the only free lunch that you've got. You don't want all your assets moving in one direction.
Yeah, and one advantage to private markets is you usually don't know what they're worth and you can't sell them quickly. And the reason why that can be an advantage is because I've seen a lot of entrepreneurs sell their stock portfolio at the worst time and thinking it's never going to come back or it's going to keep getting worse. And boy, it's hard to make those predictions and know when to sell and when to buy. However, I was just talking to one of our entrepreneur clients that you know that I won't mention that told me, he said, if I would have just taken all my money and put it in index funds instead of all the stuff that I tried, all the crazy private stuff I tried, he said he did the math and he'd have about 3 times the net worth he has today just by doing that. And that's not a suggestion that you should go out and just buy the public markets. It is a suggestion, though, that a lot of young entrepreneurs, when they have a lot of money, they throw money at private deals and they make a lot of mistakes. So try not to do that piece of investing that a lot of entrepreneurs end up falling victim to.
Yeah, well, I mean, even when we always study the billionaire asset allocations, we always talk about, and we reviewed that on a show in the past, that the public equity still represents about a third of the billionaire's allocation. So boring old Mr. Stock Market is about a third of the portfolio. Yeah. Now, again, a lot of entrepreneurs are maybe told, hey, go to talk to a big wirehouse or a big investment advisor, and they're going to put 100% of your money in stocks and bonds. Well, the billionaires aren't doing that. Again, they're maybe around a third up to 40-50%. So there is a reason that the billionaires are investing a substantial amount of their net worth in alternatives. So it's all about, like everything in life, being in the moderation, right in the middle there.
I think the difference, though, would be that billionaires have a system and a process and a team that vets things, and often entrepreneurs are just talking to their buddy and throwing money in there. So I think there's incredible opportunity in the private markets, but there's also risk of just making dumb decisions where if you can buy index funds and eliminate a lot of the dumb decisions. Whereas with the private markets, you got to know a little bit of what you're doing and you have to have some people helping you. But once you have that, as you said, there isn't any billionaire that I'm aware of that doesn't have significant amount of money in these different areas that are on this chart here.
Yep. All right, well, let's keep going. So the next chart we're going to throw up here is the private equity. So from the same data set here, the private equity funds rolling 1-year horizon IRRs, and then also 1 year by size. And really what this shows is just for those listening and not viewing, in 2021, huge spike in the IRRs up to 50% or so on average, and then it kind of really came back down to 0% or so at the end of 22, and then it's been hovering around maybe 10% from there on out. And this was really a lot of nice exits that came out of the COVID boom, because right in 2021 there was a lot of money in the system, interest rates were really low, valuations were really high, so private equity funds really had nice IRRs or internal rate of returns as they were selling out from underneath them some of these assets they picked up pre-COVID and during COVID. So that was a big driver there. And then the next chart we're going to throw up here is venture capital fund. So switching asset classes from private equity to venture capital fund. Again, similar chart, but it looks even more dramatic as an even higher spike up in the VCs rolling 1-year IRR, and then a deeper trough there that they actually were underwater in late 22 and early 23, and then also some dispersion. And the thing that's interesting about venture capital, I think more so than any of these other asset classes, I was just reading an article on TechCrunch, and it was talking about how a lot of these LPs are now underwriting these VC funds to 15 to 20 year hold periods.
Wow. Because
there's so much illiquidity in venture capital, and the DPI, which is essentially how much money you're getting paid out, is so low that a lot of them are cutting their allocation to venture capital because it's underperformed the NASDAQ. So why would you want to invest in the venture capital if you can get public liquidity, public market exposure, collateralization, et cetera, for, with the same performance? So VC of all of the different asset classes, I think, feels the most stressed right now. Now, the question is why, and some people would say that it's going to loosen up a little bit with a new regime from a White House, because now deal making is back on the table, whereas the previous regime led by Biden and the FTC was really cracking down on, monopolistic or anti-competitive behaviors, and so there wasn't a whole lot of deal making. So then that really hurt, liquidity in the VC space. So it'll be interesting to see over the next 3 years, does VC really come back as an asset class now that kind of the market's open to doing businesses, or doing business, I should say.
I do think it's going to come back some. And I also believe this is one of the riskiest areas for entrepreneurs, because as an entrepreneur, I get more VC startup stuff from friends and other people raising money than I get anything else. And just like we talked about at a recent call, remember when we talked about private equity and how they're getting more pressure for distributions and for giving money back, because more and more investors want to get money back. It used to be just the multi-billionaire family offices were investing in these things, and they don't care if they get the money for 20, 30, 40, 50 years. And with VC, they're illiquid, and you really shouldn't expect any money for years. And it could be 5 years, 10 years, 15 years before you get the exits. So this is an area that especially I think entrepreneurs need to be careful. And also, I'd rather, if you don't know what you're doing, find a VC fund or someone who manages VC money professionally, rather than just trying to pick your buddy's startup that might work for you. And I know for me personally, Mimi and I, as you know, one of the things that have cleared our lives in the last few years is I want to invest in anything that's pre-revenue. So I have a VC fund that we put money in, and that VC manager can make the decisions. But anytime someone comes to me and says, "Hey, Jim, will you invest in my deal?" I say, "Is it pre-revenue?" "Yep, I'm out." And that saved me a lot of time and a lot of money. Not saying that you shouldn't consider things that are pre-revenue, but that's just a place where I am in my life that I don't want to mess around with the pre-revenue deals.
Yeah, I hear you. I mean, and I think venture capital, at minimum, you got to invest in 10 portfolio companies at minimum to get enough at bats to hopefully get one home run there. And I mean, when I look at my portfolio, venture capital is the only asset class that I've got nothing in, because similarly, I don't want to source enough deals. I don't trust enough deals. I've seen too many clients strike out on deals. And then now, as I see more and more of the funds performance, there's really a huge, if you're in the best funds, you can get great IRRs, but a lot of the middle kind of run-of-the-mill funds are really lagging the market, and you don't have the liquidity. So I've stayed away from venture capital overall as an asset class, and I will say I have no FOMO in that one.
That's good.
All right, let's talk through private debt. So private debt and private credit is blowing up. That's been the bell of the ball really since 2022, 2023. In that environment, the Fed really started increasing interest rates as we came out of the COVID cut cycles and free money on the table. Inflation was rampant, so the Fed cut interest rates. Well, unlike bonds, which took a bath at that time, private credit performed very well because it's generally a floating debt instrument. So usually it's SOFR plus maybe 5 to 6%. So SOFR floats with the interest rate environment. So you were getting 12, 13%, at the high end. And if you're, it depends on what your collateral was. If they were making just investments to different operating businesses, you're probably 12 to 14%. Whereas if you're making loans, the manager's making loans to infrastructure like data centers or to real estate, you're probably closer to 8 to 10%. But private debt's done really well. And then the next chart up on the screen here is just going to show you the rolling 1-year IRRs by the different types. So mezz debt, general debt, direct lending. And you can see that's all over the board, but really kind of hovers in around that 10% space. And the interesting thing is, as you look at this data, it's starting to trend downwards and to the right. And this is becoming a very, very crowded trade. And now, as Jamie Dimon says, right, there's never one cockroach. And so Jamie Dimon's throwing some rocks here at private debt and private credit.
Yeah, I like it as a diversifier for an income source, but I think you got to be more and more discerning about how you're doing that. And one thing that I've seen with entrepreneurs in the last several years, when private credit was doing so well or was really leading the pack, as you said, is they're almost acting like, oh, I can get 8 or 10 or 12%, and it's better than what I get in the bank. Yes, of course it's better than what you get in the bank, because the bank doesn't have risk and private credit has risk. And I think a lot of times entrepreneurs, especially if they hear it's collateralized by real estate, they're like, oh, there's no risk and I can get a risk-free 8% on my money. And the truth is there is no risk-free 8% on your money. So you need to understand what the risks are and be comfortable with them, and then build within the portfolio and your allocation to make sure that all that's being taken into account. It's not just a way you can get 8% with no risk.
So 8%, no risk. Jim, have you heard of infinite banking?
I have. I've heard of infinite banking, cash flow banking, bank on yourself, the LEAP program. I've heard of a few things that are tagged with those kinds of marketing slogans.
Yes, that is a joke. That is an overfunded life insurance policy, which is, I would say, generally oversold to our clients. I would say they don't market as 8% no risk, but I've heard 7% no risk before. So your comment made me chuckle, because if I were an insurance salesman, that would be my response. And we know there's more to the story there.
Yeah, we should spend some time on that at some point. And permanent life insurance is a tool and has its place, but as you said, it's oversold, and often the entrepreneur doesn't really understand these products, and they're buying from the person that brought them the idea, who makes a commission for selling the product, and that's a recipe for a problem.
Yeah, I think maybe 5 to 10% of the clients I see that have deployed capital in that don't end up regretting it. So the inverse of that means 90 to 95% of clients who end up purchasing one of those big policies ends up regretting it. So,
yeah, it's unfortunate because there are real reasons for life insurance and its different categories, as well as not for just for asset protection or for things like estate equalization or estate taxes or even replacement of income, or there's tax advantages in using it, for distributions. But to your point, it gets oversold, and often entrepreneurs regret what they did in that space. And it's too bad. It's because they don't have representation and they feel comfortable with this person and all the proposals are great. And then they move forward with something that later they feel like they made a mistake.
Yeah, a paper tiger. Looks good on paper. Mm-hmm. All right, let's talk through real estate. So next chart up we're going to show here is real estate index quarterly returns. So you can see this chart at the beginning of the timeline in 2019, up and to the right pretty much besides a COVID blip through the end of 2022. Well, what happened then? The Fed just starts hammering interest rates higher, and now these bars are all down, which means down, 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 down. And again, as interest rates go up, cap rates go up, the value of, assuming you don't increase your net operating income, all else equal, the value of real estate goes down there. So real estate's had a huge run up in COVID, and I think a lot of people have felt that if they've owned real estate coming out of the COVID bubble, they're very happy. But as we know, it's very expensive now. Interest rates are high. A lot of people have been cut out from the market. And the data here kind of shows what the sentiment that is felt.
Yeah, one thing I see with real estate is too often, and this is with any investment, entrepreneurs fail to stress test their investments and stress test their overall allocation and their plan. Because if you were to stress test some of these multifamilies and just said, well, what if interest rates go up 2, 3, 4, 5%? What does that look like with the deal that I'm in? And if they would have stress tested, they would have said that's going to be a problem because a lot of these are variable loans. A lot of these have covenants that they have to meet. And entrepreneurs, many of them didn't do that. And they just believed real estate always goes up and never has a problem. And of course, there is no investment that always goes up and never has a problem.
Yeah. Yep. All right. Last asset class here, real assets. So real assets, think of this as infrastructure. You're going to have oil and gas, different things like that. And then the last chart we've got here just shows oil and gas, infrastructure, metal, timbers, and agriculture. A little bit steadier. Oil and gas is obviously going to be a little bit more variable just because as the price of crude moves around and there's geopolitical risk, that's going to ebb and flow. So during COVID, you can see there's a line light blue for those of you who can't see, down 30%. And that's just because when you're going to a recession, the demand for oil really falls off of a cliff because if trucks aren't driving, if people aren't buying stuff, if we're not moving product around the world, there's not a lot of demand for oil. Whereas when we go to the boom cycle, which you can see oil really ripped up higher to up 40% in 21, 22, that's just because, again, there's a lot more demand for the oil and gas. And that's why we'll talk about this in the future, but diversifying your vintages when investing in oil and gas is very smart. But
yeah.
All else here, this is a little bit more of a diversification play, and you can see these are starting to nestle in around 5 to 10% kind of annualized returns.
Yeah, it's funny when you mention the oil and gas and the drop in demand during COVID. I remember here in Phoenix, Scottsdale, the air was so clean. You could see from where we are, Camelback, clear as day, because no one was driving any cars. And if you're not driving cars, you're not using gas. And so the demand dropped dramatically, and we had beautiful air here for a few months.
Yep. All right. So that's what's going on in the alternative asset classes, the different actual historical performance here over the last several years, where they're at, where they're going. And again, billionaires have about 40 to 60% of their liquid net worth in these exact asset classes. And so this is a big piece of how the richest and the smartest people in the world are investing their money. And again, I think for a lot of 8 and 9 figure entrepreneurs, it makes sense to also diversify into these different alternative asset classes.
Yeah, most definitely.
All right, let's transition here to our last segment here from the fractional family office floor. So Jim, here at Do Wealth, we're all in on AI. We think that's so important to drive more efficiency and to drive better outcomes for our employees, most importantly, and also for our clients. So we've started integrating some custom skills through off-the-shelf AI into our Microsoft 365 suite, and we're starting now to build some proprietary AI agents. And I was curious that I saw this World Economic Forum data, and they published the core skills required for success in 2030. And these are radically different than some of these skills today. So we're going to show this chart. Again, World Economic Forum essentially said, hey, here's some emerging skills in the top left quadrant. There are out of focus skills in the bottom left quadrant. And in the bottom right quadrant, steady skills. And then the top right are going to be the core skills in 2030. AI and big data is a new one that went into that, but we're going to go ahead and break this down. So first thing, Jim, give me your gut reaction when you're hovering in and zoning on that top right quadrant. What is surprising to you and what are your takeaways?
Well, one that's interesting is creative thinking, because I think some people are thinking AI is just going to do the thinking for me, but creative thinking is going to be a core skill. Because even though AI can tell you a lot of things and AI can be creative, the true creativity of the human mind is always going to be very powerful, even in the world of AI. So I was a little surprised to see creative thinking there, but the more I think about it, the more I see that as a core skill in 2030. If you have great creative thinking, even in our organization, when we talk about AI, it's the creative thinking around AI that is making the difference, not just the AI itself. So that was one that jumped out. Resilience, flexibility, and agility. That's also a powerful one for a core skill. And that's probably always been important, but to see that it's even going to be more important in 2030. So if you have kids, making sure your kids are resilient and have flexibility and agility and practice creative thinking rather than just doing something over and over, I think that would be really critical.
Yeah, I think you're spot on. Technological literacy, obviously incorporating AI into your day-to-day workflows and your day-to-day life. It's just, that's the standard now. That's just part of doing business. If you're not doing that, you're getting left behind. And curiosity, lifelong learning, those are right self-efficacy skills along with the resilience piece you're talking about. Working with others, that's empathy and active listening. That's leadership and social influence, some other skills that are going to be in the top right quadrant. Steady state, but still important. And then it's interesting that declining skills, precision, reading, writing, and math. I mean, that's stuff that AI is going to crush. Already is crushing us in.
I know. I'm kind of sad as a former public school math teacher to see that that's not going to matter as much, but I get it. I mean, when I was a teacher, they go, well, I have a calculator, Mr. Dew. Why do I need to know all this kind of stuff? And what I would always tell them is it makes your mind stronger. And I still think reading, writing, and mathematics can make your mind stronger, your brain better, and be able to do other things better, even though it's not going to be a skill that's as necessary in the future environment.
Yep. And I think 3 takeaways, right? That's going to boil this down. I wrote this down. Hard skills are commoditizing. So like we talked about reading, writing, math, the things that made you, the things I was taught in the 90s, right? That this is the most important thing, commoditized by AI, right? There's no more differentiating there. Meta skills rising. So learning how to learn, knowing how to learn, how to be creative, how to work with machines, right? Just how to figure stuff out. Those meta skills, I think, are super, super important. And then lastly, technological literacy, non-negotiable, right? I mean, for anyone who wants to be relevant over the next few decades, if you're not competent in incorporating AI, everybody else around you is. You're trying to get by with one arm or two arms tied behind your back, and I just don't think that's scalable.
Yeah, I've heard some business owners almost threaten their employees, like, if you don't get good at AI, you're going to be fired. I don't think that's the right approach. But in the reality of it, there is some truth to that. You know, if someone falls behind and doesn't learn and keep up with AI, then eventually they're going to be replaced by someone who can utilize AI in that position, or maybe their position gets replaced. And if they're not showing other skills, they don't get moved to somewhere else in the company or into the new areas that will need more employment.
Yeah, and as we tie this into, again, from the fractional family office floor, this is about our business. Looking at our P&L, we're investing over 1% of revenue into AI, whether it's off-the-shelf software, customizing AI agents and models, and we're incorporating this into our quarterly retreat. So every quarter we fly our entire team into Scottsdale, super important from a team building perspective, and we're doing another AI presentation. We got teams carved up, and each team is going to be presenting out a specific project that they've been working on and that things that they can automate and up-level using AI. We're going to have some prizes. We're going to have fun, maybe drink a little bit. And so I'm excited. And that's just how we're encouraging our team, not only the monetary investments into AI and investing into them in a safe and scalable manner, but also then incorporating it into our offsites, gamifying it, just making it fun. And that's, I think, very important.
Yeah, I was talking to a group of entrepreneur friends of mine the other day, and I talked about we're doing this contest, and they were really excited. And one of them said, I'm going to bring that to my employees. That's a great idea, is to create a contest, create some excitement. And then also, you know, improve your ability in the AI space. It's huge. And I know for us, I'm very excited because our type of business lends itself to being amplified and improved by AI, not replaced by AI. Because the complex planning that we do and those kinds of things, I would be concerned if I was a traditional financial advisory firm that did the normal stuff financial advisory firms do, because I think if that's not already there, I think AI very quickly will be able to replace a lot of those services and skills.
Well, Microsoft agrees with you because it says that a traditional financial advisor is number 30 on the top 40 to be replaced and most susceptible to being replaced from AI. So yeah, those typical 1% AUM advisors are in trouble. All right, last thing to before we send it off here, and this is a question I'm thinking about all the time as a father to young kids, but what does the future look like with AI and my kids? And I have no idea the answers here, but there's the last chart we're going to show here is unemployment rates by educational attainment and age. And there's starting to become some data that perhaps shows that it's getting harder and harder to get that entry-level job because of AI, because a lot of companies are now like, well, if I can just make my existing people more efficient, or if I can just get an experienced person and then stack AI on top of them, do I really need that entry-level position that may be more, really honestly may not add a whole lot of value to the company besides just some inputting, some blocking, some tackling, and those are kind of the skills that AI is really good at. So this chart here just really shows that there's been a slight uptick in the unemployment rate of if you just have a high school diploma, but really negligible. The associate's degree, not too bad. Some college, no degree, not too bad. But then a huge increase in the unemployment rate for bachelor's degree and graduate degree, specifically from 18 to 19 through 23 to 25. So as a data point, the bachelor's degree, the unemployment rate was 3.8% if you just graduated 7 years ago. Today it's up to 4.9%. So a 1.9% or 1.1% increase, which doesn't sound too bad, but that's about a 25% increase in the unemployment rate for that cohort. So I know anecdotally, talking to my babysitter, actually, she's a nurse and she got a new job, and her boyfriend is just got a general business degree. He's graduating at the same time. And she said that it is very, very challenging for him to try to find any opportunity. And she said that he's looking at positions and like even looking for that job, it's $40,000, like cold calling. Like that's kind of now where he's relegated to try to just get anything, which is sad.
Yeah, that's tough. I think whenever you see a new technology, I heard a couple of years ago a futurist on AI. And he showed every time we had a major change, a major development, whether it was the combustion engine or the personal computer or now AI, ultimately it's positive economically for everybody. It's positive for job growth for everybody. And he was very adamant that it will be in this case too. But then there's this in-between period when there's this change of the technology. And during that period, there's some adjustments. And I think this is one of them, because the whole idea that you can get a degree and then just get a great job, it's going to matter more to the company's hiring. What difference are you going to make in my company, and how can you use technology and AI and creative thinking and some of the other stuff we talked about to add value right away? Because I can bring in AI and do a lot of what you're already doing. And so that would be the thing that I would stress. And I know your boys are really young, but as they grow up, make sure that they are focused on those core skills in addition to doing all the things you're supposed to do. Also, develop creativity, develop skills, social skills, be able to understand AI and technology. And of course, your kids will have an AI advantage. That's what I predict.
I like it. I totally agree. All right, that's a wrap here today, Jim. We always wrap up. Biggest takeaway. We covered a lot of ground today. What's the biggest takeaway for you?
The Family Office LLC. I see so many entrepreneurs who've had exits, who have big balance sheets, and they're really not, first of all, having things organized in a way that actually make sure that their management is done in a really productive way, but also missing out on tremendous tax deductions that they can get. So I'd say the Family Office LLC would be my takeaway today.
Yeah, I totally agree with you. And I was talking to you about I had a coffee a few weeks back with a 9-figure CEO who just had a liquidity event, not a client, and we were talking through, and I was asking them, hey, are they going to set up the LLC, and are they going to do the family office? And they're just like, yeah, I don't know how to do any of that kind of stuff. And so I totally agree. There's a lot of opportunity for people who do it right, who follow the tax court case, et cetera. And I think the biggest piece too is it's not just the tax angle like we talked about, but also how do you incorporate governance and succession planning. I think incorporating that into your dynastic trust structure, like all of these pieces really need to be connected, but that's where you can create a really, really cool structure that's going to last for multiple generations if that's what you want. Because some people are like you and they want to give all their money to charity. Okay, that's okay. There's still value in creating a structure like this, but I know a lot of entrepreneurs really want their legacy to be something bigger than them, and tying that Family Office LLC into that and tapping into that's super important.
Yeah. Well, of course, I'm not going to give 100% away now because I have to take care of our little girl.
Yep.
Our 4-legged goofy dog.
Yep. Awesome. All right. Well, that's it, Jim. Good seeing you.
Good to see you.
We'll be back in a few weeks.
Yeah. Sounds good.
Thanks for listening to the Make Rich Real podcast, where $1 million businesses meet billionaire strategies. Please note the following disclosure. This podcast is provided by Dew Wealth Management, an SEC registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performance is for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available on our website, dowealth.com, or upon request.